Hello everyone, welcome back to TechnoChart's YouTube channel, and in today's video I am going to talk about a backtested intraday mean reversion trading strategy. So what is reversion to mean? Now mean reversion is a concept in finance that suggests that after an extreme price moves, stock prices tend to return to regular or average levels. Now what are these average levels? Basically average levels are the moving averages that are present on the chart. Now after an extreme price move, let's say if a stock has moved 10 to 15% in a day or so. Okay, so let's assume that the stock price has moved 20% in 2 days. Now after some time you will see that the stock price has generally stayed sideways, or it will generally pull back to the nearest moving average, that is the 21 EMA, that generally provides the stock a dynamic support in a trending market. So let's take an example of Adani Power. Here we see that after extreme prices move, that above the moving average, basically the 21 EMA, that is the red line, you will see that the stock price again pulls back to the moving average again and again. So this is generally a low risk high reward opportunity. Whenever you look for an entry opportunity in such kind of stocks, you have to wait for the reversion to mean, that is, wait for the stock price to come back near the moving averages and then take a position in those stocks. Because if you take an entry at extreme price levels, let's say extreme gap ups or gap downs, then these do not provide you a low risk high reward entry opportunity, first thing. So the risk appetite or risk automatically increases if you buy an extended stock. Okay, so the what is the hypothesis behind our trading strategy? Now basically what we are looking for is, whenever the stocks have a large opening gap, they tend to come back to the mean levels. And we have backtested this strategy in Nifty 500 universe, and probabilities are calculated on the stocks that have highest chance to fall back to the moving averages again and again, basically. So let's say that there are 10 stocks that are opening gap up. Okay, let's assume from NSE 500 there are 10 stocks that are opening gap up. Now out of these 10 stocks, the probabilities, the algorithm is calculated, or the using our proprietary software, we have calculated the probability of each and every stock, which stock has the highest probability to come back to the moving average. Because not all stocks are definitely going to the moving averages, right? So each stock has a different probability depending upon their historical data. We have done that, and after that the highest probability trade is given as a short trade for the day. Okay, so basically this is an intraday selling strategy. So we are shorting a stock intraday by using a mean reversion trading strategy. After the stock price opens huge gap up on that day, we calculate the probability of different stocks that have opened the gap up above the normal average levels, and then we wait for the stock price to pull back to the moving averages. Now these probabilities are ranked based on proprietary algorithm, and the stock with the highest odds are selected. Okay, so let's take example of Hikal. Now Hikal on Hikal had we had given Hikal as a trade. Fresh short trade was generated on this by this model. Now the stock fell 10% in a single day using the same model. Okay, so let's open the chart of Hikal here and let's understand it practically. Okay, so here we see that Hikal had opened around 1.5% gap up only. But you might have assumed why it only opened 1.5% gap up. So there could be many such stocks that are opening 1.5% gap up. And why was this stock only given as that trade? Right? So basically, as I have mentioned, we are calculating the probabilities of each and every stock, and the stock with highest probabilities given as a trade or is taken as a short trade for that particular day. And on that particular day you see that the stock has been down 10% in a single day. Okay, so this was one example, and similar example are like Anupam Rasayan, where the stock fell 5% in a single day after the stock price opened around 1% gap up only, and then it fell around 5% in a single day. So what are the sell rules for the strategy, basically? So the probabilities are already calculated, and we get to know what are the stocks that are opening gap up or gap downs, right? So in this case we get to know at 9 8 a.m. that these are the stocks that are opening gap up, the probabilities are automatically calculated, and the stock which has the highest probability basically is given as a trade. At you have to take an entry from 9:15, basically not 9:15, so you can take a entry from 9:17 to 9:20 am, so that you are avoiding the first 2 minutes of volatility basically, and the stop loss basically. So the point is, what is the stop loss for each and every trade? Now we have calculated the backtest, and we have backtested the strategy with numerous stop losses, and the stop loss that has provided us the best returns is 10% SL for that day. Okay, intraday 10% SL. So let's assume that the stock has opened 7% gap up on that particular day. So in that case, our SL would be 3%, that is 10% limit. If a stock opens 2% gap up, our SL for the day is 8%. Now you might assume, or you might ask, ki 10% gap up or 10% stop loss is a very huge stop loss in intraday basically, right? I agree that 10% stop loss is a huge stop loss, but the probability of hitting a 10% stop loss is basically around 5% or so, around 5% only, right? So that is what the probability of hitting our fire 10% SL is around 5%. So that is why it has given us a good opportunity basically. Now what is the capital that you are required to trade basically? So capital that is suggested to start trading the strategy is basically 1.5 lakh rupees in intraday. Now this does not include the margin that is provided by the broker. Why? Because as we are trading, as this is a high risk high reward trading strategy, so we do not recommend you to basically use the margin that is provided. And basically what is the position sizing that we are going to do? 50,000 that is there in this is an additional buffer. So extra 50,000 we have kept for drawdowns and everything. We are going to use 1 lakh for the strategy only 1 lakh for the strategy. So let's assume that hikal is a trade where 255 is the basically the stock price of that of hikal. Now what is the position sizing? How much quantity of hikal you should be buying on that particular day? So 1 lakh basically divided by 255 is the total quantity that you should be buying for that particular day, and this comes at around 200 350 or so, approximately 350 quantity. So you know that the maximum that you can lose in a day is 10,000 on that on a particular day, that is 10% of your capital. And we will now go and check out what are the strategy backtest details. Okay, so this is one more example of Astadium where the stock price has fallen 10%. Now most of the time you might have observed that after the stock has opened huge gap up, these stocks are continuously falling. So that is the logic, or that is why this strategy has given huge returns in the past, because most of the time you'll see stock that opens gap up tends to come back to the moving average and falls continuously. So some of the stop loss trades, as we see, as we have, as you already know basically, that we do not only show the profit, we have to cover the stop loss trades also. So in this case our 3.2% SL was hit and shorted on the gap up, but basically the stock moved completely sideways and stop loss was hit at 3:20 p.m. That was around 3%, right? The next example was Mangalore refinery and petroleum basically. So gave a short trade, the system gave a short trade, and the stop loss was hit at around 320 to 325. So now the model backtest and statistics basically. So the model was trained for 7 years where all the type of market conditions were covered, right? So we have covered bullish markets, bearish markets, and sideways also. And using a volume filtration criteria, we have tested this model basically on 257 stocks. So out of 500, we have filtered out some of the stocks using some volume criteria and some liquidity criteria, and then we filtered out from 500. We tested this strategy basically on 257 stocks, right? So you will see this is the basically, I'll provide the presentation link in the description below. You can download the presentation, you can join the telegram group of investment also basically. Now the biggest winner was in a single day. This statistics basically mean what are the gain or loss in terms of thousand. So the biggest loser was 9,000 rupees we have lost in a single day, and the biggest winner was we have made 24,000 in a single day, right? You will see average holding duration is only 6 hours, and this is an intraday trading. So we'll exit the strategy at around 3 3:15 to 3:20 p.m. or so. The win rate of the strategy is 67%, so it has a very good win rate, as well as you see that it has a good risk to reward ratio. So average win size is 2.3 and average loss size is 1.7, minus 1.7 basically, and maximum drawdown is minus 50,000, right? So that is why we have kept a buffer of 50,000 in our strategy, because maximum drawdown could be a 50,000. Now this is an income generation model rather than compounding, so basically whatever profits and losses that you make are to be withdrawn from the account. Basically will not keep on compounding our profits basically. Now here the number mean how much the profits are down from the peak profits we made in that particular month. And basically this is the monthly drawdown for the quick short portfolio. What is the maximum drawdown that we have faced in a particular month? So in some months we have faced 9% drawdowns, in some months we have faced 15% drawdowns. So basically this is a high risk high reward trading strategy that as I'm mentioning again and again. And this is the total number of trades that the stock or the that sorry this is the total number of trades that the strategy gives basically. So averagely you'll see around 20 trades are given in a particular month. So only the high probability trades are given. So that is one thing key, we are filtering out the noise of unnecessary trades and taking the highest probability trades for that particular month. And on less than 1% of times out of 700 trades had 10% SL hit basically, right? So now in this picture you will see that these are the percentage returns in a given month. And example, in March 2020 the strategy made a profit of 29,000 on 1 lakh, and the strategy made around 18,000 loss in December 2021, right? So now what are the pros and the cons of the strategy? So we are not having any kind of overnight risk for the strategy. First thing, this strategy has given consistent returns from the past and has been tried and tested in all market conditions. So that is one thing key. You can this is not curve fitted key, it works only in bullish markets or it works only in bearish markets. So it will work in all the market conditions. And limit we are only getting high probability trades. So these are the pros of the strategy. The cons of the strategy are the strategy has high drawdowns. Okay, basically as you have seen, the strategy has high drawdown, and risk of capital is basically 10% of the capital, right? So these are the cons of the strategy. One more thing that you have to remember is you have to take each and every trade from the strategy. Why? Because this is a system based trading and not a discretionary trading, right? Now you might assume that I want to take trade one day and I don't want to take a trade on the next day, but the system does not work like that way. We have to understand the law of large numbers. If you continuously trade a strategy, then only you will be profitable. Otherwise, you if you jump from strategy to strategy, then it is of no use, to be honest. So we have talked about how to position size. Basically we have to divide the stock price divided by the capital, that is 1 lakh rupees. So in case of, let's say, if the stock price is 1000 rupees, so in that case we will get 100 quantity. Now what are the model risks? So what are the risks in the strategy? This is a very volatile strategy. In extreme cases, a max stop loss of 10% is there on the capital. And now you're not advised to use market order, but use limit order, so that you can avoid those slippages, and slippages can cause extra losses. And you it is advised not to use intraday brokerage that is provided by the broker, because it can blow up your capital entirely, and you cannot randomly participate in the trades. You need to take all the trades to get the model returns basically, right? So this was about an intraday trading strategy that we discussed using a mean reversion trading strategy. If you like the video, do share it with your friends, and the link of the presentation is there in the description below, along with the Telegram channel link. Do not forget to like the video, because we are coming up with one more intraday trading strategy, that is a backup trading strategy, which is basically a mean reversion trading strategy again. And definitely these strategies can give you a good return over a period of time. If you like the video, do share it with your friends. Thank you.